This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
Welcome back to TradeFlow TV. You know the drill. Markets move fast, and if you're not ahead, you're under. It is Friday morning, June 5th, 2026, and as trading desks prepare to close out the week, the global macro board is flashing massive warning signs. Signs are across commodities, foreign exchange, and central bank pipelines. Nobody wants to hold unhedged risk over a highly volatile weekend. Let's get you caught up for the Friday open. First up, the 60-second global macro flash. Brent crude is pinned at $106. The physical oil squeeze is relentless. Following an April surge to $138 per barrel, the EIA projects structural deficits. The EIA projects that massive structural deficits will keep Brent prices pinned around $106 per barrel through May and June. The math on the global oil deficit is staggering. The EIA expects global oil inventories to free fall by an average of 8.5 million barrels per day. This free fall will continue throughout the second quarter of 2026. Meanwhile, the EUR-USD channel is holding near the 1.16 mark. The broader euro complex remains heavily under pressure as structurally high energy costs drastically diminish the appeal of currencies. This is especially true for heavy oil importing economies. The ECB is locked and loaded. The deposit facility rate stands at 2.00%. However, markets have almost entirely priced in a hawkish outcome, showing a 92.0% probability of a 25 basis point hike to 2.25%. This hike is expected at the upcoming June 10th meeting. A pause at this point would be a massive shock to the system. Finally, global energy markets remain trapped in severe instability due to the de facto closure of the Strait of Hormuz. Daily Brent crude oil implied volatility has recently spiked as high as 106% as algorithmic traders react to the ongoing conflict. Let us take a deep dive into the tipping point of 2026. We are watching a profound structural shift play out live on our terminals. Here's how this directly impacts your portfolio heading into the weekend. Forget the speculative paper short theses. The EIA's projection of a $106 Brent baseline for June is backed by undeniable physical constraints. The global oil market has been fundamentally handicapped by the de facto closure of the Strait of Hormuz, a primary transit artery. This artery previously handled nearly 20% of the world's oil supply. Due to a heavily delayed reopening schedule, the crisis continues. A prolonged recovery period is required for shut-in oil production. The EIA forecasts an overall global inventory decrease of 2.6 million barrels per day. This 2.6 million barrel decrease is for the entire calendar year. You cannot print your way out of a physical supply shock. This puts the ECB in a hawkish corner. The 92% market probability for a rate hike to 2.25% next week proves a point. It proves that central banks have their hands completely tied. European policymakers are stuck battling increasingly hot headline inflation. Elevated energy prices are aggressively bleeding into all other sectors of the economy. The ECB is essentially forced to tighten. They are tightening monetary conditions into a weakening manufacturing environment. While survey-based inflation expectations have cooled, the physical reality of the energy market does not give Christine Lagarde any room to issue an all-clear. And it is not just the Eurozone feeling the heat. Emerging market contagion is spreading. Central banks are forced into defensive hikes. Bank Indonesia recently raised its benchmark rate by 50 basis points to 5.25%, specifically to strengthen the rupiah. This is a move to barricade the local economy against imported inflation. The Middle East conflict has effectively forced central banks worldwide. They are forced to tighten policy at a much faster, more destructive pace than anticipated. Here is the TradeFlow take. Fridays in a live-fire conflict zone are notoriously dangerous. The unipolar financial world is cracking under the weight. It is cracking under the weight of constrained energy flows, with Brent crude heavily supported above $100. Central banks like the ECB are all but guaranteed to hike rates. Cyclical and growth stocks will face immense resistance. Hedge your dollar exposure, keep a very close eye on the EUR/USD channel near 1.16, and ensure your portfolio is protected. Stay liquid, stay sharp, see you on the next one.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.